The US dollar has just suffered one of its sharpest single-day sell-offs this year, plunging over 3.25% against major rivals after Friday's non-farm payrolls report missed expectations dramatically. Yet this morning, the 10th of August, 2026, that slide has ground to a halt. The dollar index is holding above the psychologically important 100 level, stabilizing around key support at 99.41. So why has the post-NFP dollar weakness suddenly paused? The answer lies not in the jobs data itself, but in a geopolitical flare-up that is reshaping risk appetite right now. On Friday, the Bureau of Labor Statistics released numbers showing U.S. jobs growth fell well short of forecasts. A non-farm payrolls number is simply the net change in employment excluding farms, government, and a few other categories. When it misses, it signals a cooling economy, and traders immediately priced in more aggressive interest rate cuts from the Federal Reserve. That sent the dollar tumbling and the British pound flying above 1.3500 for the first time in months. But over the weekend, the narrative flipped. Renewed threats to shipping in the Strait of Hormuz, a critical oil choke point, sent crude prices higher and reintroduced safe haven demand. The dollar, long a haven during global crises, began to recover as the risk of supply disruption overshadowed weak payrolls. This morning's price action reveals a market in tug-of-war. Gold, which had surged to a 7-week high on Friday, is now moving steadily lower, indicating that haven flows are rotating back into the greenback. Sterling is holding above 1.35 but unable to extend gains. And crucially, oil prices remain elevated, creating a direct challenge for central bankers. Weak jobs data scream for rate cuts, which normally weaken a currency. Yet higher oil costs keep inflation sticky, which limits the Fed's room to ease. That contradiction has trapped the dollar between two powerful forces, and for now, the safe haven bid from Hormuz risk is winning the day. The near-term path for the dollar hinges almost entirely on headlines from the Middle East. If tensions escalate further and threaten actual supply disruption, the dollar may strengthen further, potentially erasing all of Friday's NFP losses. If diplomacy prevails and oil retreats, attention will snap back to the Fed's likely easing cycle, and dollar bears will target a break below that crucial 99.41 support, opening the door to the 98 handle. Technically, a daily close back above 101.50 would be needed to confirm a short-term bottom. Until then, every statement from Tehran or Washington is effectively a market-moving event. No major U.S. data is due today, so keep a close eye on any unscheduled Fed commentary. The post-NFP dollar sell-off is not over, it is merely on pause. Geopolitics have interrupted a fundamental downtrend, creating a classic risk-on, risk-off battle that can flip on a single headline. Do not get lulled into thinking the dollar weakness is a one-way bet. Stick to tight stops, watch oil prices and the Hormuz news flow, and remember that at this moment, fear of supply shocks is more powerful than fear of a U.S. slowdown. That is your key takeaway for this Monday.